today we're going to do something, tips on building a portfolio, because it is a topic in general that people are very interested in. And I feel like we don't do enough on that. And so we're going to talk about the investment side of things. We talk a lot about structure, right? We talk about the goals process and coming up with an investment strategy. So we're going to look at the investment side of things today.
And as a reminder, that is setting a goal. That's figuring out the return needed to achieve the goal and then picking an asset allocation that can get you the return you need to achieve that goal.
Right. And then you document your investment strategy. And that, of course, helps you pick the actual investments you have, make sure they're aligned to your goals, and it makes sure that you do not succumb to bad behavior.
We've really just summed up our whole job in 3 sentences.
All right. Let's go get a martini then.
So let's start with diversification, because part of building a portfolio is choosing how many holdings are in it.
Yeah. And so obviously this is very dependent on what you are investing in. So whether that's individual shares or an ETF or a fund that's already diversified. But we're going to talk philosophically today about diversification.
So let's start with the simple purpose of diversification. And we're told diversification is to not put all your eggs in one basket. So what do you think of that?
I mean, it's a nice little sound bite, right? It just doesn't tell us what to do. So I'll talk about me. The reason I diversify is I want to remove single security risk from my portfolio. So that's it. Nothing more, nothing less. That's my reason for diversifying.
And single security risk is simply the risk that something bad happens with one share that you own. That something could be anything. It could be fraud at the company. It could be bad management decisions. It could be a competitor crushing them, or new technology, or something else that makes their product or service obsolete.
Yeah. And maybe you picked up on this. So Shani said something bad happening. That is what risk is. And really what's something bad happening in your portfolio is permanently losing enough money so that you can't achieve your goals. And that is my worry personally. That's why I diversify. And this is not, of course, a unique view on markets. I borrowed it from this guy named Warren Buffett. He's an obscure investor in the Midwest in the US.
An obscure investor that we've based a drinking game around.
That is true. That is true. And what he talks about, he says that for each individual investment he makes, he's trying not to permanently lose capital. And what I've done is I've just taken that and put it on an overall portfolio perspective. So we'll contrast this with the way that many investors approach diversification in a minute. But I want to use a real world example from my portfolio. Now, this is a failure of mine, Shani, and I know that that makes you really happy.
We're just going to do one failure today?
How long do you have? I do have a lot of failures, but this should be an exciting episode for you.
Okay, let's do it.
All right. So I recently sold a share, and I did that because it no longer fit my thesis for when I bought it. And I bought the share back in 2011. So Shani, you were like 4 years old, like running around your parents' yard with your Nimbus, whatever 1000 broom.
Nimbus 2000.
Yeah. So
it was like a plastic broom.
And your parents bought it for you at a yard sale, right?
A garage sale, they call it here.
Okay.
But
same difference.
Yes.
So anyway, that's what you were probably doing in 2011.
I mean, I was in university in 2011, so I hope not. But
okay, well, there we go. Either way, I was buying Intel. And I won't go through the whole sad story of Intel, but Intel used to be a wide moat company. It paid a generous and consistently growing dividend, and it's basically fallen apart. So they are in the technology business, obviously. They make semiconductors, and they fell behind. Their competitors did a better job. They lost their moat. The shares have fallen 55% in the past year. And things haven't been going great for a while. So I think I was probably too patient with Intel. But anyway, that's just kind of my approach as a buy and hold investor.
How bad was this of an investment for you, Mark?
Well, so I didn't actually lose any money. I will say that. I was up 10% when I sold it. The issue is, of course, I bought this 14 years ago, and obviously people have seen what's happened in market. So making 10% on a share in 14 years especially these 14 years, is really, really bad. So I would have made more money if I put that money into a savings account. All right. So the point is that if I invested my entire portfolio in Intel, I'd obviously be in trouble. So for 14 years, I would have earned a return well below my required rate of return. I would have never accomplished my life goals because I didn't foresee basically all the other semiconductor, Taiwan Semiconductor, AMD, NVIDIA, just, I don't know, kind of kicked Intel's ass across the board in the semiconductor space. So it's a good thing I was diversified.
Yes. And the point is that by diversifying, Mark lives to fight another day. But he built a portfolio to reduce the risk to his goals so that one or multiple of his investments, if they don't work out, then he's still okay.
Yes. I'm okay financially. In other ways,
We'll see.
Not so much. All right. So we want to contrast this, as we said, we want to contrast this with another interpretation of diversification. And that interpretation is that you own a bit of everything. So you spread your bets far and wide.
And I think we need to step back and think about the purpose of diversification. The purpose of diversification is to lower risk. The question is, what risk are you trying to lower and by how much? Let's start with this notion that you're trying to lower single security risk. If you own one share and you buy a second share, you've lowered risk. If you add another share, you've lowered risk further. And the same process goes on until you own every share and you've eliminated all single security risk. The question is, where do you stop? And it's hard to know this.
And then there's this other notion of what you're trying to do with diversification, and that is that you're trying to eliminate volatility. Now, we start hearing terms when we're talking about volatility, we start hearing terms like correlation. We are told that you should own shares or other investments that aren't correlated, which means their prices often don't move in the same direction. And that, of course, lowers volatility.
So now we're trying to eliminate single security risk and volatility. So we have to own lots of each type of investment and we have to own lots of different types of investments. And things are starting to get complicated here. Taken to the extreme, a diversified portfolio is now owning shares in every sector, in every country, both developed and emerging, in every market cap from large companies to small companies to medium-sized companies. You own every type of bond and you own gold and crypto and everything else you could possibly imagine.
Yeah, and I think there are a couple different points that we can make here. There's a trade-off for everything that you try and do. And what you are doing if you try and own everything is you are choosing to have a really complex portfolio. You have lots of different types of investments to keep track of. There are lots of different things that can be adjusted. That includes the asset allocation to all of these different asset classes, and then, of course, the actual investments within those asset classes. And there's a lot of temptation when your portfolio is this complex. There's a lot of temptation to tinker with it.
Now, we don't think that people should tinker with their portfolios. We think that most people can improve their results if they just trade less. But even if you agree and that is your strategy, there's still a lot of work that needs to be done with a really complex portfolio. It is work you might have to do because you need to rebalance between all these different asset classes, or it might just be extra work by making contributions to your portfolio and figuring out what to buy or figuring out what to sell if you're in retirement and you need to support withdrawals.
And of course, the big question is, if volatility is a risk you're trying to remove, is why are you trying to lower it in your portfolio in the first place? So for most investors, and we've talked about this a lot on here, for most investors with long time horizons, volatility isn't that important. So what you're really doing by trying to eliminate volatility is you're just lowering returns. And we'll walk through an example because examples are good, Shani. So shares have a correlation of 0.25 with market neutral funds, according to Guggenheim, which is an investment management firm, not just a museum.
There you go. And market neutral is a strategy where long and short positions are used to remove the impact of the overall direction of the market. And instead, returns come from the stock picking skills of the manager, both what they take long positions in and what they take short positions in.
Okay, so hearing that description, it shouldn't be surprising that there is a low correlation with just the market in general, because you're obviously removing that market risk. But the question ultimately is, what are you getting out of this? So Credit Suisse has an index that tracks market neutral hedge fund performance. And since the inception of the index in 2004, the average return has been 0.72% a year. So from a cumulative return perspective, the index is up 15.65% since 2004. The S&P 500 is up 683% over the same time frame.
And this is obviously an extreme example, but I do think that if you ever hear the sales pitch that an investment has a low correlation or negative correlation to one of your key holdings, you do need to take a step back and be a bit skeptical. If this investment is uncorrelated to something that goes up most of the time and goes up over the long term, you're likely doing yourself a disservice.
And if you are worried about volatility, and there are certainly some times when you want to consider volatility, I think you just need to think about how you do that. So you can lower the volatility of a share portfolio by owning shares that have lower volatility. So big, boring dividend payers with low business risk, for example. If you want to lower the volatility of your portfolio, you can do it with cash. I just wouldn't stray too far from what's simple, because as we said, there are going to be downsides to that.
All right. So Mark, how do you diversify your portfolio?
Okay. So as I said, I try to remove single security risk. So I've got a little rule that I don't want a single share holding to be more than 5% of my total portfolio, or 5%, I guess, and 5% of the total income, because I'm an income investor. So ETFs, as we said, they are already diversified. So I'm much more comfortable with a significantly larger percentage from an ETF. And I kind of make a ETF by ETF judgment call. So there's some ETFs that obviously track broad indexes. There are some that are, in my case, dividend ETFs that are a little bit narrower. I just try to think about if I could achieve my goals if something went wrong with one of these positions. So in terms of everything else, I don't care. I don't try to have each sector represented. I don't really care about international diversification because I generally own large global companies. They do business all around the world, so it doesn't matter where they're listed or headquartered. I don't care about market cap. I just buy things that meet my criteria and focus on the long term. What about you, Shani? How do you diversify? Or is this a private question?
No, I think you're okay to ask me that. I'm a little bit different. I don't buy individual shares and I just have a long-term strategic asset allocation that I do follow. But I also try not to overcomplicate things and I focus on things that are within my control. So asset allocation, tax, fees, other costs, trying to minimize these costs that will impact my return outcomes is built into the decision-making process that I have to include or exclude investments. And I just ensure I know what I'm buying and I understand how it connects to what I'm trying to achieve.
All right. And there'll be a quiz at the end of this, by
For
the
me?
way. Yes, of your favorite Mark failure story, because we've got another one.
Oh, God. All right.
I mean, I assume you're just going to pick the one that was the biggest failure.
What was the biggest failure?
It's the story I'm about to tell.
Okay.
So,
I thought you meant like all of your failures. I had to like reveal one that was my favorite.
well, I guess you could do that too. I'm talking about the two failures we're talking about.
All right.
on this podcast. Okay, so this is a lesson for people who have been listening to this whole diversification thing and saying they don't think it's important. Or the lesson could be, I'm just an idiot and they can do it better than me. But the notion here, if you are an anti-diversifier, is you run this highly concentrated portfolio. And really the idea is then your best ideas get more of your money. And if they pay off, you profit. But it's also a little bit dangerous.
Okay, so tell us your story.
Okay, here it comes, Shani. So my father-in-law spent his whole career at Citigroup. And he was generous enough to, over the years, give my wife a couple shares each year as a Christmas present. So over time, this built up and the shares appreciated significantly. So we got married, we combined finances, and I looked at our overall portfolio, and 15% of it was in a single company. It was in Citi. So I obviously knew this was a bad idea. I'm not an idiot. I would never build a position that large in my portfolio. And I obviously could have easily fixed the problem. The issue is, of course, I didn't, because the shares had a really, really low cost base. And I didn't want to pay the taxes on the capital gains. So I knew there was something wrong. I didn't want to do anything about it. I just didn't want to face that downside of fixing it. So I sort of reasoned and justified my way out of it, which is what a lot of investors do. When they know they're doing something wrong, you just justify it. And I just thought, okay, I'm young. I'll fix this problem with time. I'll save and I'll invest more, and it'll slowly dilute this position. And this probably would have worked. The problem is, of course, this little event called the GFC. I don't know if you've heard of it, Shani. You might have actually been in a pram when that happened. But
I feel like I was a little old for a pram. I feel like there would have been a serious problem.
Well, okay. I mean, I don't know your parents' technique with raising you. I mean, I kind of do, but I won't share it on the podcast. But so anyway, of course, the GFC happened. Citigroup went off a cliff. The good thing is that capital gains problem I had when your largest holding goes down 97% in 18 months, you don't have to worry about capital gains.
So how different do you think your life would have been if you hadn't made this mistake?
Yeah, it would just be crazy. I'd be on this podcast.
I don't think you would be on this podcast.
Smoking cigars, lighting them with $100 bills.
Well, you shouldn't do that in Australia. They're plastic. So...
That's true. That's true. What you guys need is some paper money.
Yes.
Yeah, I mean, listen, it was a very expensive way to learn a lesson. I think the biggest thing was, and I think we say this all the time, there's always this advice that like young people can take risks. Like, oh, invest in whatever you want. Like, well, the problem is when you're young, what you're giving up when you lose money, and what I gave up was time, right? There was all this time that could have compounded. So yeah, I was in my 20s. There was a lot of time ahead of me. I'm still alive at 45. I might make it to 46, despite your predictions. But anyway, as I said, it was a very expensive mistake to learn and something I think about a lot.
All right. Do you have any more failures to share?
I mean, obviously, how long do you have? But why don't we leave it at 2 for today? So which was your favorite one?
I'm going to say my favorite was the second one.
Because of how large the failure was?
No, because it means that now you're sitting here and you're doing a podcast instead of somewhere on a yacht.
Okay. To be clear,
good for me, not good for you.
To be clear, it wasn't that large of a position, but sure, that's alternate life. I am on Sydney Harbor right now, sitting on a yacht. And who are you doing the podcast with? Don't know.
Will? We could talk about crypto.
There we go. Yeah. You'd be on a crypto podcast. Yeah. It would have 20 times more listeners. And yeah, your life would be a lot better too. So it's really too bad. But anyway, thank you guys very much for listening to our impromptu podcast, impromptu topic. We really appreciate it. Any comments, questions you have, taunting me about my failures, my email address is in the podcast notes.
This video has been prepared for clients of Morningstar Australasia Pty Ltd and or New Zealand wholesale clients of Morningstar Research Ltd. Any general advice has been provided without reference to your financial objectives, situation or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.